First, debt. Dalio's concern that mounting government liabilities could become unsellable aligns with the ECB's fear of funding vulnerabilities. Banks may look well capitalized now, but in a shock scenario, especially one involving geopolitical stress or capital flight, those capital buffers could be tested to the limit. Second, geopolitical fragmentation. Dalio repeatedly points to a breakdown in the post-World War II multilateral order. The ECB, too, sees geopolitical risk as central to its threat model. Insurance Journal. If global institutions fracture, capital could retreat to perceive safe havens, triggering liquidity dislocations in Europe. Third, technological and climate disruption, two of Dalio's key forces. The ECB's warnings about cyber threats, AI risk, and climate-driven shocks dovetail with his larger narrative, Le Monde Franc. In effect, both Dalio and the ECB are sounding the same alarm from different vantage points. Dalio as a macro historian, the ECB as a banking regulator. The convergence of their warnings makes the risk harder to dismiss. To truly grasp the magnitude of the threat, we need to walk through the corridors of history and imagine what a modern crisis of this shape could look like. Picture this. It's 2008 all over again, but not just a housing meltdown. This time, the trigger is fragmentation on several fronts. In boardrooms in Frankfurt, bank executives scramble to run their reverse stress test models. Under the ECB's new framework, they must ask themselves, what could break me? For some banks, the answer is a cyber attack. For others, a sudden run on funding triggered by geopolitical shockwaves. Across the continent, economies reliant on U.S. exports, autos, chemicals, pharma, see demand collapse when trade barriers snap back or political tensions erupt. Corporate defaults spike, and banks begin to mark down loans aggressively. Simultaneously, climate disasters intensify. In Southern Europe, water scarcity hurts agriculture and energy sectors. In Northern Europe, flooding disrupts logistics and real estate. These are not distant warnings, they're real, immediate stress factors. Governments, meanwhile, are managing debt that has ballooned in the wake of stimulus, pandemic rescue, and climate investment. The global bond markets start to fray under the weight of supply. As Dalio warned, not enough buyers are willing to absorb the debt. Liquidation begins. Central banks intervene. The ECB demands recapitalization, but some institutions simply don't have the liquidity to survive. In this gripping scenario, history doesn't repeat. It morphs into something new, something more complex, a systemic crisis driven by 5 overlapping, interacting forces, a black swan that central banks predicted, but no one could exactly define. This is not fantasy. The ECB's warning is anchored in real policy changes. As part of its 2025 to 2028 supervision roadmap, the ECB will aggressively prioritize this reverse stress test, investing.com. Meanwhile, the European Banking Authority, or EBA, recently launched a massive EU-wide stress test covering 64 banks, about 75% of EU banking assets. European Banking Authority. Under its adverse scenario, GDP could plunge by 6.3% over 3 years, 2025 to 2027, driven by geopolitical shocks, trade disruption, and systemic financial distress. European Banking Authority. Even as the ECB warns of unprecedented risk, it also acknowledges that banks are relatively healthy today. Profitability is strong, asset quality is stable, and liquidity positions remain comfortable. Insurance Journal. The ECB has decided to hold the Common Equity Tier 1 or CET1 capital requirement steady at 11.2% for 2026. Investing.com. But here's the catch. The calm may be deceptive. The non-binding buffer, called Pillar 2 guidance, is being eased, suggesting that regulators believe banks can absorb shocks, but only if those shocks are understood. What if the next banking crisis doesn't come from what we know, but from what we can't imagine? The European Central Bank, ECB, is now warning eurozone banks face unprecedentedly high risk of shocks. And one of the world's most powerful macro investors, Ray Dalio, says this could be a symptom of something far worse, a breakdown in the global monetary order itself. In November 2025, the European Central Bank dropped a bombshell. In a stark supervisory roadmap for the next 3 years, the ECB publicly warned that euro area banks must brace for extreme, low-probability events. Shocks coming not from the run-of-the-mill crises of the past, but from a new, unpredictable world. Geopolitical tensions, trade wars, climate disasters, demographic change, and rapid technological disruption, these are no longer distant worries. The ECB said these structural vulnerabilities are stacking up, pushing the odds of unthinkable events higher than ever before. In response, the ECB is calling for stronger capital buffers, modern infrastructure, and more intrusive supervision. But perhaps most strikingly, it's demanding a reverse stress test. Instead of giving banks a hypothetical crisis to model, supervisors will set a point of capital exhaustion and ask each bank to imagine what kind of shock could bring it there. This is not business as usual. It is a wake-up call. To understand why the ECB is sounding the alarm, we need to go deeper. The vulnerabilities it cites are not minor. They're structural, systemic, and long-term. On one front, geopolitical risk, shifting trade policies, sanctions, and friction between the US and Europe threaten sectors that dominate banking loan books, like automotive, chemicals, and pharmaceuticals. Then there's climate risk. The ECB has warned that nature-related crises, droughts, extreme weather, resource scarcity, could trigger financial stress. These are not hypothetical. Southern Europe, for example, faces severe water risk that could disrupt agriculture, energy, and industrial lending. Demographics, too, are working against banks. Aging populations, shrinking labor forces, and shifting consumer behavior all contribute to a murky economic future. And on top of that, technological disruption, including cyber attacks, AI risk, and financial instability brought by rapid innovation. The ECB's message is clear. The next crisis could be different, not just a replay of 2008, but a shock from entirely new directions. In the world of global macro, few figures loom larger than Ray Dalio. As the founder of Bridgewater Associates, he predicted the 2008 crisis. Today, he warns that the world is entering a perilous phase, late in a historic debt cycle with 5 seismic forces colliding. Dalio frames his concerns around what he calls the 5 major forces shaping history: debt cycles, internal political conflict, shifts in global power, technological change, and natural forces. In recent years, he has made increasingly stark predictions. Speaking at the World Government Summit in 2025, he described global debt as a severe threat. At a time when U.S. borrowing is exploding, Dalio said the world may not be willing or able to absorb it. In a television interview, he warned of something worse than a recession, a collapse of the monetary system itself. In his view, the accumulation of debt functions like a clogged artery in an aging body, and without action, the system risks a debt-induced economic heart attack. Dalio's diagnosis: the same forces stressing Europe's banks are part of a broader global risk spiral, one that threatens not just individual institutions, but the very foundation of the international financial system. When Dalio speaks about debt, conflict, and systemic risk, he's not just theorizing. His worldview intersects powerfully with what the ECB is warning. In parallel, the ECB's Governing Council has observed that global geopolitical uncertainty, especially around trade policy, is at its most intense point in decades, raising the likelihood of more negative scenarios materializing. European Central Bank. All of these steps together, reverse stress tests, capital enforcement, intrusive supervision, show that the ECB is not simply warning for headlines. It is structurally preparing the euro area banking system for something profoundly different. What does Dalio propose? What does it look like when a man who studies cycles calls for action? First, he urges fiscal discipline. He argues that nations, particularly the U.S., but also parts of Europe, must dramatically reduce their deficits. At the World Government Summit, he called on governments to reduce annual shortfalls to around 3% of GDP, criticizing current borrowing as dangerously unsustainable. Fortune. Second, he warns that unless policymakers act, the next financial shock could be far more severe than a typical recession. He sees the risk not just in banking or stock markets, but in what he calls a monetary order breakdown, a fracturing of global trust in the system of debt, currencies, and credit. Fortune. Third, Dalio recommends that investors rethink their portfolios. He has advocated for 10 to 15% allocations to gold, treating it as insurance against extreme risk when fiat currencies and bond markets falter. Finally, Dalio's message to global leaders is bleak but clear. If you ignore the debt problem and global fragmentation, you are risking a shock that will be more than temporary. It could change the entire world order. What is at stake here is not just the solvency of European banks. It's the future of the global financial system. If the ECB's warnings are right, eurozone banks, even strong ones, could face liquidity stress, funding runs, or capital drains triggered by shocks that do not perfectly align with historical crises. What happens when those shocks arrive? When risk isn't a textbook scenario, but something explosive, unexpected? If Dalio was right and global debt reaches a breaking point, we might see not only bank collapses, but a transformation in how money works, how countries borrow, and how global power is structured. That isn't a distant risk. The ECB is acting now. Dalio is warning now. The question is, will the world heed the alarm before it's too late? So what can we learn from this urgent convergence of voices? First, risk is evolving. The future shock may not resemble past crises. Climate, geopolitics, and tech aren't optional extras. They are central to financial stability. Second, historical cycles still matter. Dalio's analysis of debt, power, and conflict draws on decades, even centuries of patterns. The past may not repeat, but it often rhymes. Third, regulation and supervision must adapt. The ECB's reverse stress test is a provocative exercise, not just about punishing banks, but forcing them to imagine worst-case scenarios themselves. Fourth, individuals and investors must take macro risks seriously. Whether it's holding gold, diversifying globally, or simply paying attention to central bank policy, the cost of ignoring systemic risk may be far higher than we realize. Finally, leaders must not wait. Dalio's warnings are not hypothetical. They are a call to action. Debt won't fix itself. Fragmentation doesn't heal by chance. And megatrends don't pause for regulation. If this story resonated with you, hit like and subscribe. Turn on notifications, because we'll continue tracking Dalio's warnings, the ECB's stress tests, and the unfolding risk to Europe's banking system. Share this video with others, your friends, colleagues, or anyone who cares about the future of money. Let's spark a conversation, because the most powerful protection in times of crisis may be informed vigilance.